Well, welcome everyone to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money killer commentator. On today's show, reducing your tax bill, part one in our series on end of the year tax planning with author, speaker, and nationally recognized captive insurance company expert, Wes Sierk. Welcome to the segment, What's up, Wes?
Thanks for having me.
I'm glad to have you here. We've had you here before,
Yep.
And you're a major player in the business market. And you have books out on captive insurance companies for people who say, not only do I want to reduce my tax bill, but I also want to figure out if there's a way to save on insurance premiums.
Correct.
So that's a big play.
And
that's where you
another
go.
book.
Coming out
And,
when?
well, and my other book is called You Can Make It, But Can You Keep It? And it goes through a lot of asset protection and tax reduction strategies. And I am writing a new book right now called No Tears on Tax Day.
I'm into not weeping over my tax bill because I wrote a serious check last year. So I just want you to know. Now, that's in one part, that's good. In another part, well, I managed it as best I could and still had to write a check. When we're talking about basic end-of-the-year tax planning, I'm amazed. I've been in this business 35 years. You'd think consumers, we'd all be kind of hip to what's going on in the year, but we're so busy. We don't have time to learn. Who's going to sit down and learn the tax code, right? Nobody. And is my CPA or my accountant or my enrolled agent of the IRS, is that person going to be able to be proactive in my finances to help me? So I want to walk through some of the basic ideas of reducing your tax bill and make sure we have some basic vocabulary down. So Wes, when I'm looking there, I see three things in the code. You know, most people read their 1040. What do I really need to know? Well, I need to know what my tax deductions, my legal deductions are. I need to know my tax exemptions. I need to know if I'm going to get any money to apply against my tax called tax credits. So walk me through tax deductions and some of the stuff that we should be looking for before the end of the year.
Okay, tax deduction is basically off your income, the stuff you can deduct. Let's use mortgage interest deduction as an example. And you mentioned CPAs, you know, are they helping or hurting you? But I did a seminar for CPAs and I gave them a very simple set of facts and said, person has this first mortgage, this second mortgage, they paid it down to this, they refied, what's the amount of mortgage interest deduction they could take? 100 people in the room, one got it right. So
that's scary.
it's basically $100,000 more than the lowest indebtedness the property's ever had, even if you refied it. So, but yeah, it's looking at all of the different deductions, half of your, if you're self-employed, half of your self-employment tax. There's a whole list the IRS has of various deductions. So that's the first place to start. Make sure you take all of the applicable deductions that you can. I don't know if most of your clients use, what, TurboTax? But TurboTax has actually gotten a lot more sophisticated in saying if you have this, these are some deductions to look at.
Now, when you're using a software program like that, it's pretty thorough, right? It's going to walk you through almost, I wouldn't call it advanced, but it's up there. There's some, intermediate kind of knowledge that as long as you know how to fill in the blank, right? That's the goal here, the good data collection, you could walk in there. Now, you mentioned, mortgage interest, big one. And of course, GOP's talking about maybe changing some of this so that guy, it's going to be dicey. The second thing,
Who knows?
Yeah, who knows? Property taxes, of course, things of that nature. I think people that own a home know that.
Deducting yourself, your state taxes, state and local taxes. That's a big thing in the new tax bill because they're talking about eliminating those SALT deductions, the deductions for state and local taxes.
All right, well let's just go down there. So let's say I know I'm going to have a tax bill for my state. Should I pay that December 31 instead of wait until April 15th?
I would say yes.
And especially if this law changes.
Correct.
All right, so that's another issue. Our residential state, if we know we're going to have to write another check, maybe we ought to need to write that check December 31.
Correct.
Okay.
And that's what we do. I mean, I'm in California, which is a high tax state, so every single year we make sure that check gets penned, and our clients' checks get penned also, so they can take those deductions. On
this side of the year, December 31.
Correct.
Okay, so that's a big issue. All right, now when I'm talking about other deductions, I'm talking about let's say if I'm a business, I might want to take the biggest deduction. I might look at a SEP IRA. I think it's like 54 grand. I mean, that's a big chunk of money. If I want guarantees and I want to walk into a pension, I might look at a 412I plan. I might even want to look at some kind of standardized way of looking at, hey, should I be doing an IRA versus a 401k, my practice, whatever it is. I need to look at those numbers. What is deductible, what isn't? But from straight up, if I'm a regular business owner, SEP IRA, 412I maybe, my wife and I take in our maximum IRA, And I noticed, this is another, I want to ask you about this, HSA accounts. I mean, that thing can be up to $75.50 per married couple. That's totally deductible, and all the money can come out. I don't have to wait till 59.5, right? Is that my understanding?
Yep.
That's a major deduction, and you get that money free as long as it's used for med.
Yep, exactly. And who doesn't have medical expenses? I mean,
everybody.
Yeah.
And I just told one of my friends who's on Medicare, I said, if you don't want to write that check for Medicare because he's not taking his Social Security yet, pull it out of your HSA account, Medicare, long-term care. If you're under and you're saying, Steve, I'm on Obamacare, I'm on you could take it right there from there. So there's legitimate disability insurance. So there's a lot of places to play here for deductions before the end of the year. Exemptions. Now, let's just shift gears a little bit. Okay, I'm married. We have the two people. We're getting $4,100, I think it is, $4,100 or $4,050, something like that for this year. I'm looking at that number, and then my children. Now, that could also change coming up in this new law. But right now, each person, so if I have a lot of children, this could be a big play. In fact, my kid used to hit me up when he went to freshman year in college. He basically said, hey, I hear you get a deduction and you made some tax savings. Where's my part? You know?
Really?
Yeah. Like, hey, don't watch my show with that much. But we're looking at exemptions. So we want to make sure we're getting every legal exemption. And if you're taking care of a senior, you can get exemptions. If you have blindness, there's different exemptions. There's a little senior perk for a little bit more because of your age. So there's places to play. Some of our clients get tax credits, okay? I'm getting a tax credit. And remember, they're talking about doubling the child tax credit in the GOP, but there are a lot of tax credits that people don't know about that if they actually just went through, and like turbo taxes as your example, you could take that as a credit. Now, some of these have phase-out rules. If you make too much money, then you're really not going to get that deduction. You're really not going to be able to get that exemption. You may not be able to get any, you won't get any tax credit for that. So when you're looking at these three areas as a planning tool before the end of the year, do you cite this and go to your clients and say, here's your list of things. Have you done this, 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 and this? Get ready to write some checks here. You need to do so.
Yeah, correct. That's what you do.
Now, go ahead.
I find the best way to do is look at the entire business and figure out what they have. And then from there, you don't have, you mentioned qualified plans. You don't have a SEP. You don't have a 401k. You don't have a 412I. Do that. We may get to inventory purchases. Can you go and buy inventory? Can you accelerate anything this year because you expect a lot of it has to do with tax planning, not only for this year, but next year. If you expect your income to, go up substantially next year, you may want to bring in stuff for this year.
We're right in the prime time for this, aren't we?
Correct.
We're on both sides of the year, right? So if I'm hearing correctly, if I knew I was going to have a pretty good increase in my actual income next year, I might want to take some on this side of the year.
Correct. You may want to bring some, and that's what we just did. The end of my year is November 30th. So yesterday, I'm at Best Buy buying all new computers because I wanted that deduction for this year. And then I said, okay, well, I expect income to be coming in. I want to take it this year versus next year because next year will be bigger than this year. So I accelerated payments coming to me to just basically lock it in. Now, I do have people that clients right now are saying, well, aren't tax rates going down under the new bill? So that's the general thinking is, well, I'll just wait till next year. But you have to look at individual circumstances. And for many people, even if they lower the rates, they're not going to see a substantial drop in their taxes. If anything, they'll see an increase.
There's a couple of things going on in this bill, and one is, yes, you might experience a lower tax effective bracket, but you may not have the deductions you used to have. So I don't know if it's really going to be a wash or more.
Exactly. I'm planning on it actually going up because let's say you can't deduct your state and local taxes. That's big. So you pay 34% on would you rather pay 39 on a smaller amount or 34 on a much larger amount? I mean, that's the kind of planning you do.
Well, and I think that's really good when people are listening and say, when we're doing tax planning, we're not just doing it for 2017. We're kind of looking at 2018, the impact. I think we need to start thinking in dual years that butt up against each other and try to come to a place where we can manage our taxes. Now, this little heads up, because every time I go into a seminar, just remember all of us going on to Medicare here coming up pretty quickly, your income for the last 2 years is an issue. And if you have a certain amount, you will not be paying the $134. you will be paying a lot more. And I just had a client that said, Steve, what can I do? I'm making $200,000 joint, with my wife and our Magi, modified adjusted gross. And I said, find out if your employer will let you delay some of this income over the next couple of years, because the moment you walk in, you're going to be paying more for Medicare. So all this income management this year and next year matters.
Tax management is really income management. So, and you have to, a lot of it's forecasting. Is it going to go up? Is it going to, your income going to go up and down? And that's where you do all your planning around.
Well, listen, don't forget to watch our next segment on saving taxes by managing your income, the very thing we're talking about. Part 2 of our series on end of the year tax planning. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.